It is a beautiful and cold Saturday morning here in Chicago. We are on the 24th of September. We're going to take a look today at Bitcoin. We're going to do Bitcoin Elliott wave analysis. I'm your host, the Cowboy. This is Elliott Wave Cafe. Let's get started. Alright, well, first and foremost, I wanted to invite you to my Twitter channel up here at Elliott Cafe. You can come in here and, join the conversation. Any questions you have regarding charts, any suggestions you have for my videos, anything that you would like to share with me, come and join, and, we can help each other out. You'll see a lot of stuff in there. From my part, I'm trying to post interesting charts and comments and sentiment and stuff like that. So, I think you're going to enjoy being part of it. The community here is growing. I have about 126 subscribers at the moment, followers, but about 50 more than what we had last time. So things are pretty good. Right, so go ahead and check that out. You can also find me on my private channel here on Telegram that we're running. It's called the Pro Room, and we cover everything from macro assets, S&P 500, Nasdaq, gold, oil, commodities, Bitcoin, altcoins, everything there. We have a chat room and different channels where I take a look at these assets every single day. I have daily videos. So just go ahead and give that a try. There's a link below this videos for that. All right, let's get going. All right, so what I wanted to spend a little bit of time today is obviously on Bitcoin. That's the purpose of today's video, but I do wanted to start just by taking a look at this asset performance year to date. And if you see this vertical line that I have in here, this is the last time that I've done a video here for Bitcoin, and this is kind of where things were then. And I had a slide and we were looking at the performance, and here is what happened. So since about a month ago when I've done this, oil was performing about 45% gains year to date, and since then it's been doing even better if you're going back in the beginning of June, but it's been in a downslide since. So right now we're only up about 20%. So there's a pretty decent correction happening in the commodities, happening in oil. You can see the dollar here continues to gain strength, and it went slightly higher since last time. So we're up about 18% year to date, which is a pretty big move on the dollar. I talk about those, into the macro cafe that I do almost every week. And then if you look at the rest of the assets here, we're down about 10.5% on gold, and then you have the indices which are coming lower here. So you're down about 21% on the S&P 500. You're down about 25% on the emerging markets. You have the Nasdaq, so the Q's down about 30% right there. And just an overall negative year for all the risk assets. Now Bitcoin, it's down at the bottom here at about 58%. So it's the worst performing asset here today out of the ones that I'm following back in here. Now, if you go more years in the past, you will see that it's actually still, I think, outperforming a bunch of these, obviously. But it's down almost 60%. Now, what's interesting to see is that since last time we haven't done a whole lot, right? We're still pretty stable. If you watch these equities in here, they're continuing to move to the downside while Bitcoin is holding pretty steady. That's a pretty good signal, I would say, that Bitcoin is it's just kind of stable, and we haven't had any major breakdowns. And we'll take a look at the charts, but I just wanted to kind of compare with what's going on in oil. Even with the dollar spiking higher, Bitcoin is not actually crashing to the downside. All the equities are moving lower. Bitcoin is remaining flat. So again, not sure if this is just a fuse delay on this price action, or Bitcoin is actually telling something that there is strong support at these levels, and there probably might be coming some strength into this market. So just a quick look. I think it's important that we look at these asset performance on a regular basis and just see the differences between them, and kind of how the money is flowing, and what the intermarket relationships are here. The next slide I have prepared for you, it's something interesting that I haven't talked about a lot, and this is, I want you to take a look at this. It's called, a trend following model. And, a lot of these, fund managers and hedge funds and, large investors, a lot of these guys are trend followers. And this is a very kind of strong methodology in, trying to be on the right side of the market and try to stay with the flow and try to make gains on a bull and on a bear market. Now, it's not one of my main methodologies in here. I usually, look at the Elliott wave and sentiment, but I do want to show you how simple a trend following method can be, and it can be applied to any market at any time. Now, obviously, some markets are choppier than others, so you're going to get a lot more signals and false signals and stuff like that. Some of them are better trending, but it's just a simple way to look at the market and try to stay on the right side of it. You can buy when the model tells you that when the model is telling you to buy. You can go short, or you can sell out of that asset when the model is telling you to that it's going negative. So looking at the Bitcoin here, what you're seeing is basically the blue line that you see on the chart. This blue line right in here, this is the price of Bitcoin, but it is basically a 5-day moving average of Bitcoin price. So it's not a day-by-day price, which is pretty close, right? It just kind of smooths out a lot of these spikes, daily closes, opens, stuff like that. So you're just having a much more kind of a cleaner price structure. Now the green back in here, it's the 200-day moving average, and it's done as a shaded area here at the bottom. So the 5-day moving average and then the 200-day moving average. So basically what this trend following model shows you is that obviously you want to be long the market once the 5-day moving average it's above the green area, and you want it to be out of the market or short the market once that blue line goes into the green shaded area. So it's very, very simple. All you got to do is just buy when it crosses above and get out, or short when it crosses below. Now you can apply some filters to this. For example, you got to wait a little bit and see, okay, if it's going into the green shaded area, how long are you going to wait until you're actually going to sell or you're going to go short? Because you don't want to be whipped around. So, there's anywhere between, let's say, a 3%, 5%, maybe a 7% move, above and below this green area for you to be convinced, or for your system to say, that yeah, it's going to be a short or it's going to be a long, for that matter. So if you can look in here, right, in Bitcoin, you crossed over in 2016 at the end of 2015, and you never crossed back until after we found the top in 2017, somewhere in April, let's say, of 2018. So, if you look at these gains, they were pretty awesome. Now, this model would have kept you out of being long Bitcoin, for quite a while in here, because it kind of moved short. So you could also have shorted the market and then get out of that short the moment it kind of crossed, let's say, with 3 to 7% above this line. So you would still have been able to get pretty decent gains, from being short Bitcoin all the way from here, all the way to back here. Now, what this model is, it doesn't necessarily, makes you catch the lows, or to catch the tops, but what it does, it allows you to subtract most of that trend, most of the meat of that move, being short or being long. Now back in here, right, you went long again, like in April, May, let's say, of 2019, and then, you were still able to get some gains, and then got out towards October, towards the end of 2020, right? So it's still, even though you didn't sell up here at the top, because the model, obviously we're still long at the time, the moment you still were able to capture a pretty good move. And then if you went short back in here, right, then the place you got out was back here, which was almost a break even, so you didn't lose anything, but at least you are on the right side of the move. And then you got long back here, and then let's say you would have gotten out of it or short back in here. This one, right, if you have gotten short, you would have lost some money because the market actually pushed back up higher here into white, so you would have had to get out of there. So this was a little bit of a whipsaw if you went short or just be out of the market, but you know, you would have lost, because if you sold it back here and you bought it back up there, you know, obviously that would have been I'm not sure what the percentage was, but it would have been a loss. But at least, you know, you would have been stopped out. What if the market would have continued to go on higher? Now, if you went long back here, right, as it broke out of this above the 20-day moving average, and you stayed long, then you got out back when it started to turn bearish again, right, and you would have been almost a break even. So most of the times in here, you know, you would have been on the right side of the market, obviously with a few small losses along the way, but you know, all these gains would have more than made up for any losses or any chop that would have happened in the meantime. So now, when we broke, and I've talked about this with the members in the program, and you know, this 20-day moving average, it's one of the things that I always watch. It's on my dashboard. I think it should be in everybody's dashboard as a market analyst, you know, as a trader. And usually, when prices break below 200-day moving average, things are not that good. There's nothing good happens below the 200-day moving average, right? As what's his name? It's this. It escapes my name, but it's a big hedge fund manager. Paul Tudor Jones. I'm sorry. Yeah, Paul Tudor Jones says that nothing good happens below the 200-day moving average, and that's true. Usually, when you get below there, things start to fall apart, and you know, these trend following systems are constantly selling, and they're not looking back. So you kind of have to obviously put this in perspective with the Elliott wave methodology, and you know, kind of combine the two and see if you can stay on the right side of the market. So you know, by selling out of your Bitcoin or going short on the break of this 1-day moving average, you would still be short from about, I don't know, 45, 46,000, and here we are at about 20,000. Now, we don't know. I mean, if this is going to climb back up higher, right now it sits at about 28,000, right? So you still have sitting on pretty good gains. And, you know, by the time the prices turn, the moving averages will probably continue to drop, or if not, stay flat. So it would still allow you to capture a pretty good profit, even if the prices kind of turns back up higher. But again, this is just a, you know, a very simple, basic model that it's for people that, you know, don't want to be necessarily day traders. You know, they could go about their work and just keep an eye on this every day, or, you know, once a week, and just kind of see where prices relative to that 1-day moving average, and continue to, you know, stay with that methodology. Now, the next slide in here is the S&P 500, which I show you. It's the same model, right? And you're basically, you know, it's the same story. You're breaking above the 200-day. You're staying long. You know, a couple of instances here where you get out of the market. Either you save capital, or if you want to go short, you go short. But then, you know, you're long again, and you're continuing to enjoy this journey all the way up here. You know, then you get out the moment it breaks below these levels, and so on and so forth, right? And look here at the COVID crash. Let's say then even if you went short in here thinking that, you know, it's the end and things are going to collapse to zero, you know, you would have gotten out. The model would have taken you out back at break even. So, you know, no loss, no gain, you know, into a drop, into such a sharp drop like that. Same story back right here. So, you know, you had a little bit of a whipsaw back in there, right? This rally that we've had before the larger drop. So maybe that would have created a long signal, but then you drop back below that one. You should have been out of the market, maybe short, and continue to stay short. With the 200-day moving average on the SPY sitting at about 420, 419. And this, it's still kind of telling you that, you know, it's being out of the market in cash, or being short to the market, you know, it's still kind of a favorite approach. The moment this moves back above that level, you know, then things are changing. So again, this is just a, you know, just a basic, just one of the most basic trend following systems that are out there, and I wanted to kind of share this with you guys, you know, to see if you like it, and you know, if it's slow enough for you or active enough for you to deploy it, or maybe in separate accounts or whatever. But you know, go ahead and take a look at this, and you know, if you're deploying this, or if you have been deploying this, let me know how it works, or you know, how it works for you in the future. All right, let's continue to go. I'm going to move on to talk about why we're here, and that's the Elliott wave count. So this is the main count that I have, and this is, you know, I've been having this one for a long time, and you know, I review it every single month here for the YouTube, and you can see, you know, we're watching a wave 2 cycle that was complete here, then a wave 1 and a wave 2 setback, and you know, we pulled on this correction, we pulled 78.6% of this entire advance, so a pretty deep decline. And you also have this huge trend line, right? This massive trend line from these lows that are connecting back here, and you can see that we're starting to crack a little bit below it. Now, that's not necessarily a good sign. You want this to kind of hold and not to penetrate this by too much. So it starts to worry me a little bit, but you know, I still think it remains valid as long as we stay above these lows in here, above these 17,600, which we're, you know, fairly close to at the moment. As long as that remains untouched, I think this count continues to stay valid. So, you know, it's a little bit under pressure, right? But remains one of my the main count that I'm watching for 1, 2, 1, 2. And it's hard to believe that this could actually pan out at the moment where you're having, you know, such a big sell-off and such a big drama in the rest of the equity markets, and the Fed is doing what it's doing with the liquidity withdrawal and all. So, you know, you might just look at it and say, man, this ain't gonna work. You know, it's basically like, what are you talking about? Like, how can you, you know, put a wave 2 here with everything that's going on? But let's say that you don't know what's going on, and let's just say that, you know, you don't even turn on the news and you're just looking at counts and just say, you know, fine. I mean, this is what you're seeing. You're seeing a wave down, you're seeing a wave up, and then you're seeing another wave down, and that's all you see. You know, you don't know anything about anything else. I think, you know, under those circumstances, right, this is a pretty appropriate count, I would say. Now, if you break below these levels, then we're going to move on to the next count, which is more of a bearish count, and this is my yellow. I've talked about this last month as well, where instead of this being a 3-wave decline with a new low, here will become a 5-wave decline. You know, and there's some arguments in here that this could still be maybe a C wave, so you could be an A, B, and then 1, 2, 3, 4, and 5, and still be a C wave. But I wouldn't put a lot of trust into that. I think that the right interpretation, if we're making new lows and you know, you're coming, let's say, towards 15,000 or somewhere above 12,000, something like that, above these highs, I think the proper interpretation would be that would be a 5th wave. And you know, proper place for it to stop would be would be right above these levels. So, you know, that would create the first move down in this wave A, and then it would get followed by a you know, pretty solid rally in here in a B wave, under the assumption then this will become a zigzag. Now, this can be you know, this wave 2 back in here, the super cycle degree, can take several shapes. As you know, for second waves, you can have zigzags, you can have double zigzags, you can have all kind of a complex correction, you can have a flat. So the only thing that you cannot have in here, it's a triangle. So I don't want to talk about the type of the corrections, but under the circumstances that this is a 5-wave decline, the only Elliott wave structure that starts with the 5-wave decline, it's a zigzag, right? So 5, it would be a 5, 3, 5. If this would have been, let's say, a 3-wave move and you stop here and then you go up in 3 waves, right? And then, then you can think that fine, this could be a flat because you're going to go A, B, C, then up in 3 for a B wave. So this B wave will actually be here and it will become a flat and then push lower. So, you know, we don't really have a way of knowing until some of this stuff starts unfolding, but, you know, the normal expectation after a 5-wave decline would be that of a zigzag. So, once you find a low here, then you would have to rally up here in 3 waves. And you know, they can take you, I mean, it should take you at least to 38%. So let's say that you're dropping to, I don't know, 12,000, then you double to 24, maybe go up to 29, maybe even go up to 36, right? Because that would be based on this A wave low being back in here. Because if I move this around, obviously these fibs are gonna modify, but that would be the next move. And then that would get followed by a much larger decline in a C wave in Bitcoin that can, and this whole thing, obviously, I mean, if you can see in here, right, you start in 2022 in the beginning or at the end of 2021, and it can take you all the way to, you know, 2025 or 2026. So this could be a 3-4 year ordeal. Let's say that you've gone through one already, so that means that you'll still get another 3 years of kind of bearish price action with a bullish rally in between, which is, you know, which would be very, very welcome. So, I mean, what does this mean? That this means that even if you're under this scenario and you're looking for a rally, you know, this should come fairly soon, right? And continue to move to the upside in here. Or if you're under this scenario, you're going to get one more drop and then a rally. So I don't think we're anywhere near, you know, a huge crash in this market anymore. I think the decline already happened in this third wave, and whatever happens now, it could be maybe the remnants, you know, of this move, and you could move slowly into some kind of a fifth wave in here. It could be an ending diagonal, it could be just a regular impulse, but you know, the speed and the size of this, I think, will be kind of limited once it starts happening, if it does. And then, you know, then we will get followed by that larger 3-wave rally here in this B wave. So, you know, it's a pretty much a normal course of action. And I wanted to show you, so under both scenarios, just so I don't lose my train of thought, under both scenarios, we would be looking for rallies, either from, you know, starting now, if this low in here holds, or, you know, after you drop a little bit more, then you move higher. Now, for this to become a very super crash lower, let's say below 10,000, this would have to be some kind of a 1-2, you know, or a super extended fifth wave to the downside for some reason. But, you know, usually you're getting those on the upside, you're not getting them on the downside. Fifth waves are notorious in commodities when they push higher, those extended fifth waves. Let me just get a sip of coffee, guys. I think it's my 4th coffee this morning because I've been kind of preparing this since I woke up this morning, and I'm, you know, kind of still at it. But, so that's kind of what we'd be looking for. And maybe, you know, let me know what you think about this. I mean, it does look pretty good. It does look, especially with the S&P 500 acting the way it does, you know, it looks like it could be something that's going to happen. But until it does, you know, we're going to stay with, you know, with this scenario and see how it reacts. Now, here is what happened into the S&P 500 back in, you know, between 2000 here and 2003, I think is this, and then, you know, 2007, 2009, you know, huge flat formation. And you know, I mean, arguably this was I don't think if you can really count this as a big impulse, right? And I'm just kind of comparing this with kind of what's going on here. I think this is a much kind of a cleaner decline. This one was a little messier, but it is a flat because you made a new high in here, right? And then you can much more easier you know, decompose the sell-off into the S&P 500 as a 3-wave, and then this again as a 3-wave up in here. So 3, 3, and then sharp drop in 5. So every time you kind of have a flat formation, you have to look at the C wave to be very aggressive and very directional and super nasty. Because I see a lot of people, you know, out there with the flats and you know, they have very sloppy C waves and you know, just kind of sideways moving or not that aggressive. And no, when you get a flat, you know, when you get C wave of a flat, you don't have time to do a whole lot. okay, and we've had another flat into the S&P 500. I don't have it here. I mean, I can draw it really quickly. On the COVID, right? You went up in 3 waves. You went down. I'm sorry, it was like this. It was a 3. You came down. You went up, and then you dropped into COVID in a C wave, and then you went back up higher. So the C wave drop, from the COVID crisis, that was C wave of a flat, and that's how you can tell that's what's usually going on. So if it's not a wave A or a wave 1, depending on the larger structure, the larger trend is usually a C wave of a flat, and then obviously has to correlate with the rest of the moves. But this is exactly what can happen in Bitcoin, and this is what that is, right? With the exception that this would be a 5-wave decline, and you would get a zigzag, and this was more of the beginning of a larger flat in 3 down in 5. So this whole thing took 8 years to unfold, from 2000 to 2008, 2009, right? So a big, let's say, overall corrective market. And if Bitcoin wants to do something similar, I mean, I'm not sure again how this ties with the with the happening and the miners and the profits and all of that. Nobody knows, but this is kind of what you would have to be looking for if this thing starts to happen. Okay, so just give it some thought. I'm going to continue to kind of stay pretty bullish in here just because of what I see happening into the S&P 500. This is obviously at odds with what I've showed you back in here, right? Because this trend following system, which is very simple, tells you, nope, you're bearish in here, right? You're below the 20-day moving average. You got no reason being bullish until that happens. So it's a matter of how excited and how involved you want to be, right? And how much you want to read sentiment and catch lows and just play the sentiment game with the market. And that's kind of what Elliott wave, I think, it's good at, right? It might throw you off every once in a while, but if you develop a good sense for what the sentiment is, it can go a long way. Now, for me, I'm going to be honest with you. I did not expect Bitcoin to do this type of a move. I thought that this is going to stay still and it's going to be some kind of a triangle, and this trend will continue to the upside, right? And a bunch of people were right, identifying the fact that this was the top of the market, and they were moving lower into some kind of a larger correction. And I was not part of that group, right? I was pretty bullish, and I'm taking my hit on here. I don't have anything to hide, so I'm going to be very honest with you. I did not trade Bitcoin from the short side in any way. I did not sell any of it. So I'm kind of suffering from this decline in prices, with my wallet and a little bit with my pride as well. But it is what it is. I mean, market will, throw us every once in a while under the bus, and, it will show you, kind of what's, who's the boss, right? That is always the price, and you kind of always have to go back and just make sure that you're honest and you're you're not lying to yourself by thinking let's say bullish when the markets are actually kind of turning bearish and stuff like that. So just a kind of an honest opinion here regarding kind of how I've handled. We've taken some decent trades on the long side. I think we caught a few, but mostly personally I'm not too happy with the way I've handled myself during this decline in Bitcoin. So we'll see what happens now. I mean, again, I'm willing to accept the scenario. It's very, very viable. It becomes more viable with more pressure that Bitcoin kind of gets on these levels. But I'm also very aware of kind of the extreme bearishness that we're having, and the fact that you can actually snap back at any time in here and continue to let's say reverse. Obviously, we need to let's say coordinate this, what's happening with the monetary policy, and this one is still very restrictive. So if the markets want to get ahead of the Fed on that, we'll see. They will decide. They will show us through some rallies. But for right now, all the signs out there are that the Fed is as Jay Powell said onto his last meeting, listen, I am committed to fighting inflation and will get this job done, right? That's the we'll stay the course and we'll get the job done. Doesn't matter, you know, how much, let's say, damage we can do to the economy. But I've been talking on Twitter about this a little bit, and I think Jay Powell is slowly getting under an enormous pressure by him, you know, by his stance on the markets and by his hawkish in here. He can really create some large dislocations, and I don't think that he's prepared to handle that in case that happens, because then he will be forced to reverse course very, very quickly, just to prevent you know, calamities happening into the United States economy, right? With the housing market crashing, with people losing jobs, with, you know, getting into a very large recession. I mean, the bond market, it's already kind of showing you extreme signs of pressure in there. So I think he's you know, he's very, very close to a breaking point in these markets, and he's got to be very, very careful, you know, looking in the mirror and making sure that, you know, he maintains price stability in here. So this is not a, you know, a cry of mine, you know, towards the Fed in any way to kind of, you know, help anybody that's got long Bitcoin and long stocks and stuff like that, right? It is what it is in the markets, but it's just a read on the sentiment that's out there, and you know, how much you know, unnecessary he is becoming in here by continuing to press the same pedal over and over and over again. So yeah, that's just kind of my 2 cents on that. So sorry for my ranting here. Hopefully, you know, this makes sense. If not, I'm probably going to get some thumbs down, but it is what it is. I'm going to move on and talk a little bit about the bearish scenario in here. Actually, this is still the bullish part. So taking a look at the one-day chart, you're looking at this kind of WXY for a second wave, and then you know, I don't know if I'm forcing or not a leading diagonal in here for the bullish count. You know, it doesn't look that bad. I think it's something that, you know, any Elliottician can get behind. You have a converging price structure in here. There is no real, you know, rule breaking in any way. I think you're moving up into a series of zigzags. So in a wave 1, 2, then you go another 3 in here in a zigzag. So it's a 3-3-3-3 variety, right? And you know, it looks pretty okay. And then this was back actually from August 27, last time I've done the video, and we were looking for this A wave decline followed by a B and then a C, and this is kind of what we've gotten, right? We've gotten the A wave low, which came just a little bit lower than what I wanted, but you know, can't nail you know, everything here in Elliott wave. It's very tough. So you go 1A, and then you know that a B wave is coming, right? Just kind of what we're thought, just like kind of what we're talking about this one, right? This is the beauty of Elliott wave, that then, I don't know, with 70, 80, maybe 90% accuracy, it tells you, you know, what's about to come. You might not be precise, super exact at exactly when it happens or what's the exact levels, but most of the times you can figure out that there is something that's going to happen, right? And you can pretty much tell. And this was, you know, another one of those kind of suggestions here, another kind of projection, right? A wave in here, an impulse, and then that's followed by a B, right? And then if this is an ABC, right, then obviously after this B wave is done, you're getting a C wave decline. And as long as you stay above 17,622, this is still pretty valid. I'm not too happy with the way the C wave looks. It doesn't, you know, you can't really dissect it into a very, very clean impulse. So, you know, we'll see if that's going to end up being one or not. But, you know, so far the signs are not that good. But as long as you stay above 17,622, this remains viable. And, you know, it should lead, if this is correct, we should not break below the 17,622, and it should lead to a much larger rally to the upside. I mean, it could be, let's say, maybe, you know, maybe it's another ABC, but it doesn't matter. You know, we're looking at it as a 1, 2, 3, because we're assuming that, you know, the large correction in Bitcoin and the large capitulation was actually done back here in June 16, June 17. So we should not come below these levels if this is to kind of stay correct. But I wanted to kind of show you, you know, how this B wave unfolded, and then how now you're getting the next sell-off in here. I'm going to close off with this, which is, you know, before I do that, in case this is a fifth wave decline lower, right? In case this was a 1, 2, 3, and that's a 4, okay, then this should be a wave 1 impulse down, and this should be a 2. So 1, 2, and then it looks like you're having another 1, 2 in here. So pretty quickly, without a lot of weight, this market has to move lower. 1, 2, 1, 2, 3, 4, 5, 4, and 5, and you got to get back towards 12,000 in Bitcoin to kind of complete the larger fifth wave. That's should match this wave 1. So 1, 2, 3, 4, and then down in 5. So that's kind of how you would count a bearish structure. This fourth wave, and I'm going to take just another second to discuss this. This fourth wave. So if this is a 1, if that's a 2, that's a 3. This could be a triangle in here. All right, so you go in an A, B, C, D, and E, and still kind of move sideways here for a while, and then break lower into a fifth wave. Okay, we got some issues with some impulse. Well, actually, this would be an A, B, C off a B. So this would be a wave A, this would be a B, C, D, and E, and then still move sideways and then break. Maybe that's what Bitcoin does. So I'm not, you still have a pretty good proportion for a fourth wave in case it's a triangle or a complex structure or something. But if it is done to these levels, then you should do a 1, 2, 1, 2, 3, 4, and 5, 4, and 5. I think this is one of the things where when you study a little wave and you're in it a little bit more, or for a few years at least, right? You start to understand how some of these waves, even as a second or even as a 2, how they can unfold, and how they can make you doubt necessarily the fact that it's that it could not be done, let's say, just up into these levels. Sorry about that. Right? Because you can assume, this is a 2, that's a 4, and we're done, right? But the other half of the brain should always say, well, what if you're not, right? And if there's something happening in here still as part of a fourth wave, and that's just I think a normal Elliott wave assumption here. Sometimes you get too big of a fourth wave, and it doesn't match the second, so then you're like, come on, I don't think that's a fourth because it's getting too large. But this is still within regular proportions. So I'm going to close with the seasonality, which usually says that and this goes back to 2014, 2013 only, which is still pretty good, but what you're looking at is how well Bitcoin performs in every one of these months. So October, September, right? You got the months at the bottom on the x-axis, and then you got the percentages here on the y-axis, and you can see obviously September is one of the worst months of the year, which is kind of living to its truth even right now, and it's the same for the S&P 500. It's one of the worst months of the year, and then August is not that good either for Bitcoin. But now coming October, and here we are about a week before we getting into this month, it's one of the best months of the year following February. And if you look back, if you go and study, you will see that mostly, the month of February, even this month, this year, month of February, even though the first half of the month I think was pretty bad, the second half ended up in a bullish month, February, right? So it lived to its standards that in 88% of the time, the February month closes higher than when it opens, which is a bullish month. And for the month of October, and 75% of the time between 2014 2022, the month of October closed higher than it opened. So again, a bullish month with an average return of about 21% in here. You can see the average return is only 12% in February, but in terms of percentage returns, right here, month of October, it's one of the strongest. So does this mean that we're going to get some kind of a rally coming in here? Does this mean that maybe within a week, let's say, we would finish a fifth wave to the downside and then we're beginning a larger rally? I don't know, but I think there's something afoot here. Especially with the S&P 500 kind of threatening to break here. Dow Jones Industrial broke below but then closed back above. We're at a very, very important juncture in this markets, in all the markets. The dollar is making new all-time highs, and it's parabolic, and I think it's getting way ahead of itself in here. I've been talking about that, and I think it's in late stage wave 5 with the latest moves in there. The S&P 500 is threatening to break the June lows. Dow Jones, you know, the Nasdaq, right? You got bonds that are screaming higher, you know, with yields kind of rocking. Although for the past couple of days, bonds have been starting to pull back. So we're coming into a period of extreme volatility here for September and October. So we're at a tipping point in the markets. Either we're crashing, right, or we're holding and we're turning from here. So let's just kind of see what happens. But I think it's exciting, you know, and you know, I'm excited along with it. You know, I do hurt in some of the positions that I have. You know, I'm able to trade a bunch of commodities and just kind of continue to generate income by, you know, staying short oil, staying short natural gas, you know, trading copper, trading currencies. You know, I'm not that active into trading coins and stuff, you know, although I've seen that some of the altcoins are starting to push higher, like you saw XRP, you saw Algo, you saw, you know, there's quite a few that are moving, and, you know, XLM. You know, I think what's the other one? Chili's. I think it's one of the best performers this year as well. So there is stuff in there too. You know, and you know, I try to talk about this into the pro room as well, and I do my presentations there every day, and you know, chart updates and stuff like that. But you know, guys, go ahead and visit me up there. See if you wanted to take a trial or be and trade with me in the room. Otherwise, you know, again, sign up for Twitter. Don't forget to subscribe and like to this YouTube channel. I'll try to continue to put content out there as much as I can. Again, I appreciate you all. We're getting close to 5,000 subscribers in here. And yeah, let me know your thoughts. I'll be talking to you next week. Thanks for watching. Bye-bye.